Hey, welcome to Legals and Biz with Riz, the podcast offering you business and legal tips without the boring legalese. I'm your host, Riz McDonald, and I'm here to answer your questions and offer general advice in the clearest way possible. So grab your beverage of choice, sit back, and get ready to build your empire with Find Legal. Hello everyone, welcome to episode 5 of Legals and Biz with Riz. Today, I'll be talking about choosing a business structure in Australia. Now, before I proceed, I just want to apologize in advance if you hear any snoring. I promise it's not me. It's my dog Reggie. He's asleep and he's snoring very loudly. I haven't got the heart to kick him out. So, yes, apologies in advance. Anyway, so today, choosing a business structure in Australia. So what I want to do is talk you through some key facts for successfully choosing a business structure in Australia and give you a bit of a lowdown on how to build your new brand empire, not just brilliantly, but legally. How good's that? Now, with each option, they will come with their own pros and cons, and you do need to decide based on your own individual circumstances which option is best for you. Got it? Good. Let's go. So when you set up a business in Australia, you need to define what business structure you plan to operate with. Okay, don't worry, it's not as complicated as that sounds, but it is super important because a business structure refers to the way your business is going to be legally set up. Now, the structure you choose may impact the kind of licenses you need, the taxes, your status within the business, your personal liability, how much control you have over the business. So like I said, choosing a business structure in Australia and the right one is pretty important. Now, there are 4 main types of business structures. There's sole trader, there's company, there's partnership, and there's trust. Now, you will appreciate this podcast is not long enough, a podcast to cover every topic or structure in great detail. So I'm only going to go over some high levels for you, and I will provide you with a checklist that's going to be in a link at the end of this episode. Okay, so which is the best fit for you and your business? Well, hopefully what I'm about to talk about will help you in deciding. So first cab off the rank, let's talk sole trader. Now, setting up a sole trader is a pretty popular choice, particularly for small business owners, freelancers, side hustlers. It's the easiest business structure to set up because it doesn't really require much of anything, and I'll explain in a wee bit more detail. In fact, you don't even need a separate bank account, but can I just say I would highly recommend that you do, because with a separate bank account, it's so much easier to track your business income and expenditure. And oh my goodness, imagine at tax time the nightmare of otherwise trying to sort out the difference between your personal and business expenses. Okay, so definitely separate bank account, guys. When you operate as a sole trader, you operate as a single entity, i.e. yourself. All taxes are filed under your personal tax return, which means you use your personal tax file number, and you're personally liable for all debts and potentially any legal action too. So personal liability really shouldn't be taken lightly. Look, I'm not in the business of scaring people off, far from it. I really want you guys to shine, but you do want to proceed with caution, because as a sole trader, you will have unlimited liability. So that means basically that your personal assets like your home, if you have a car or anything else of value that could be considered fair game, is at risk. One way, however, to offset this risk is to have the right business insurance. So it's super important then to take the time to ensure you set up and operate your business legally. Couple of quick facts. To operate as a sole trader, you will need to register your business name and apply for an ABN. You may also need to register for goods and services tax, also known as GST. But that's only applicable if you are earning $75,000 or more. Now, the pros: you have full control over your assets. You have full control over business decisions. It's easy to change your business structure down the line. And you can easily employ people. However, please be mindful that there are certain compulsory obligations when you employ people, such as workers' compensation insurance. Now, the cons: full personal liability. You're liable to pay tax on all income, and you may have a limited capacity to raise capital. So, next option. Where a sole trader is personally connected to their business, a company operates as its own legal entity. So what does that mean? Well, basically, a company is owned by shareholders and run by directors. They can potentially be the same people. All the money a company makes belongs to the company and not an individual person. Similarly, all property and assets acquired by a company belong to that company. So you know all those stories you hear about founders ousted from their own companies? Well, this can happen because while a founder may set up a company, they do not own it in the same way a sole trader owns their business. Now, because a company is a standalone entity, company directors can reduce their personal liability and are better placed to protect their personal assets. However, while choosing a company structure can limit liability, it does not automatically protect your personal assets. It's important to do your research and fully understand your legal and personal responsibilities when it comes to running a company. And in general, setting up a company is more complex and has higher administrative costs than other setups. A few quick facts. With a company, you have to register it with ASIC, also known as the Australian Securities and Investments Commission, who will issue you with an ACN. Companies must also apply for a tax file number and use it when lodging annual tax returns with the Australian Taxation Office. Companies must be registered for GST if annual turnover is $75,000 or more. The rules you have to comply with when managing a company are set out in the Corporations Act. And there are certain legal documents that you need to have in place. Now, if there is more than one of you as a shareholder in the company, I would also highly recommend a shareholders agreement that sets out the obligations of each party and what happens if one of you wishes to walk away. It's pretty important. So make sure you do have that in place should you decide to go into business with somebody else under a company structure. Now, the pros. So with the pros, there is limited personal liability, there are tax advantages, and obviously there's increased legitimacy as well when you have a company structure. The cons are, if you're on a shoestring budget, it can be a bit expensive to set up. There are stricter regulations, and there is additional administration and tax reporting. So there is some food for thought there, and you do need to think about what is best suited to your individual circumstances. Right. The next option, partnerships. Now, in some ways, a partnership is quite similar to a sole trader setup. When establishing a partnership, you and the partners you decide to go into business with are personally liable for any debts accrued by the business. You also have to pay tax individually based on the net partnership income you receive. The partnership itself doesn't pay income tax. Look, a partnership can actually be made up of 2 to 20 people. There are some exceptions to this, and these are laid out in the Corporations Act. For example, 400 legal practitioners can enter into a partnership. If you've ever watched the show The Good Wife, all that talk about partners might make more sense to you now, right? Anyway, as with all business structures, there are pros and cons to entering into a partnership. Firstly, you do want to make sure that you trust your potential business pals. A partnership allows you to pool your assets with your partners, giving you stronger leverage, but it also leaves you vulnerable to your partner's debts. So if a partner was to incur debt through your joint business, then all partners are potentially liable. So when you do enter into a partnership, you need to set some rules through a partnership agreement. This is the legal document that will outline the responsibilities of each individual, and it'll determine how new partners can be added and how existing partners can exit and so on. Partnerships are governed by state and territory law, and so you should familiarise yourself with the Partnership Acts relevant to you. And I'll set out some links for you in my show notes. Some quick facts. There are two types of partnerships, a general and limited. Partnership tax returns must be lodged with the ATO. Partners are responsible for their own superannuation arrangements, and partners in business have shared control in management. Now, what are the pros? Well, the pros are it's easy to set up. There's lower administration costs. You share the workload. You can pool the assets. The cons are there's joint liability. You're potentially liable for debts accrued by partners, and it can get messy if you don't set out some clear guidelines by way of a partnership agreement. Now, the final option is trusts. Now, if you've ever watched an episode of Gossip Girl, there's about a 99% chance you've heard the phrase trust fund. But what is an actual trust? Sadly, most TV shows don't bother delving into the specifics, but we will try. A trust is an entity that holds property or assets on behalf of beneficiaries. Now, in the case of Gossip Girl, a trust holds money for rich New York City kids. In terms of a business structure, a trust holds business assets. A trust is managed by a trustee who can be an individual or a company. So when a business operates as a trust, the trustee is the person or entity who is legally responsible for operations. Does that make sense? Good. In general, there are two common types of trusts that tend to be used by businesses, a discretionary trust and a unit trust. A discretionary trust allows the trustee to distribute funds to beneficiaries in a way they see fit. A unit trust predetermines what funds or assets are delivered to beneficiaries based on the number of units held by each beneficiary. So when it comes to tax, the beneficiaries of a trust must include their trust income as part of their personal income. So people may choose to set up a business as a trust as it allows them more flexibility when it comes to tax. That being said, the ATO has been keeping a watchful eye on trusts to ensure that there's no tax evasion. And if you do wish to go through and set up a trust as an option, please do speak to a tax advisor or your accountant to discuss whether it's a suitable fit for you. Couple of quick facts. Companies can be nominated as trustees. Setting up a trust does require a formal trust deed that outlines how the trust operates, and this deed should be written up by a lawyer with experience with trusts. Trustees have set administrative tasks they have to complete each year. Now, the pros with a trust, there's more privacy afforded compared to a company structure. Trustees can distribute income at their own discretion depending on the trust structure, and depending on the setup, liability can also be limited. Now, the cons are it can be expensive and legally complex to maintain and set up. Losses can't be distributed, only profits. Borrowing money can be trickier due to different loan structures. Now, the top tip I would give here is to learn more about business structures. I've included a link in my show notes to a great video by the ATO. What's next? I hear you ask. Well, if you decided which structure is right for you, you'll need to think about registering your business and your business name. Now, regardless of whether you choose to be a sole trader, a company, partnership, or trust, you will need a registered business name, an ABN, and a tax file number. You may also need to register for GST. We also would highly recommend you run a check of IP Australia to make sure your name is not already taken before going to the expense of registering a domain or business name. Look, structuring your business properly is a major key to long-term success. Please do spend some time giving your structure serious consideration. The right decision will save you time and money down the track. I've also put together a really handy checklist that I mentioned earlier for all you budding entrepreneurs out there who are yet to get your business off the ground or have just started. So please do check out the link in my show notes. If you have any questions about choosing the right business structure for you, please do take advantage of our complimentary discovery call. I'd love to hear from you. Well, that's it for this episode of Legals and Biz with Riz. As always, thanks for listening. If you like this episode, raise a glass and show us some love by subscribing. And if you're feeling extra jazzed, we'd love a little review. If there are any topics you'd like to hear about, shoot us a message and we'll get on it. Till next time, this is Riz of Found Legal signing off.